Military conflict between the U.S., Israel, and Iran is fueling fresh uncertainty in global markets, especially in the commodity space. Joining us now with a look at the implications is Michael Craig of TD Asset Management. Michael, thanks for joining us.
My pleasure.
All right, we had a lot of big events over the past couple of days. They're still unfolding. Walk me through your thinking on this.
Yeah, to start, it's a horrible humanitarian event. The problems with war is always the ordinary person who suffers the most. So from that perspective, it's a horrible weekend. In terms of how we're thinking it through markets, trying to predict the future is a fool's errand. I mean, we have no more information than what I read and see on X and what have you, and the various narratives that are playing out. I think for our perspective, then when you go back into periods of uncertainty, you have to kind of use a Bayesian approach where what's your base case, downside case, and work from there. The optimistic scenario is that this war ends relatively in short order. Objectives are met, and we see an end to the bombing in due course, a couple weeks. That would be a bullish case. Stocks will be down a little bit. I think once the bombing ends, you see recovery, commodities, oil goes back up its gains, and we drive on. And I think the market's probably more in line with that assumption right now. The more pessimistic scenario is that this becomes a real clash of civilizations. The Iranian regime moves to desperate measures for survival, starts targeting Gulf oil infrastructure, which could see material disruptions and ultimately price hikes in both oil and natural gas. And then you have to think about kind of more serious acts of violence in Western cities if we get there. That's a much more bleak scenario. I wouldn't say it's really people's base case, but it's important to think about alternative versions. And in that scenario, it could, in fact, trip a recession if it were to play out. So again, don't want to be alarmist. We think about these things all the time, where what could go wrong and what's the probability. I don't know if that probability is high, but we have to watch that on a given day to see if it starts to increase. And those would be the two approaches that we were looking at the market today is. And ultimately, reality will probably be somewhere in between.
What do we do with that then as investors in terms of trying to figure out, because we don't know what the future holds, we don't know how this is going to resolve itself, how long it's going to take. What does an investor do?
So we took some lessons from 2022. In 2022, when Russia invaded Ukraine, the traditional approach to managing money broke down. And what I mean by that is both equities and bonds suffered double-digit losses that year. Now, will this play the same way? I don't know, but the lessons were you need commodity exposure, and we have added commodity exposure. Alternatives can be quite helpful. So owning real assets like real estate and infrastructure that tend to have their cash flows repriced to inflation, very important assets. And so as we go into this environment, we feel comfortable. We're running a fairly underweight in government bond duration, and bonds are selling off today. We had actually taken off some of our equity risk in the preceding weeks back in early February, and we have a commodity position which is working quite well today. So when we look at the portfolio today, we're probably as in good a place as we'd want to be, and we'll stick with that and kind of look for cues from the market in terms of where we shift next.
Now, investors are going to see a lot of headlines over the coming hours, days, and weeks. What do they need to keep in mind if they're trying to, take a deep breath and think about why they invest?
Right. So, I mean, we sometimes mistake wealth for cash, and they're actually two very different things. Wealth is future consumption, and it's saving cash and investing it to be able to live off or pass it on or what have you. But it is something that in the future. And for many people, that future could be decades away, could be 5 years away, could be 20 years away. And that's a big decision. But unfortunately, the mistake investors often do is they forget about that, and because they get bombarded with what I have to do right now. I got to go do this. And ultimately, it's that plan and that vision of what you're trying to achieve long term, and in the intellectual process of building that portfolio today to work through. Because look, if you're invested for another 10 years, you're probably going to see a couple of bear markets. Like, it's going to happen. And so how do you build a portfolio knowing that it might not happen today, but in maybe 3 or 5 years, you're going to have a bear market, and what are the assets you want to hold? And then tilt as you go. That is the secret to investing. But look, reacting to price moves and the current headline generally speaking, is a surefire way of losing wealth. And so, the environment is very emotional, but investing shouldn't be. It has to be a very methodical process and thinking about what you're trying to accomplish, and that's how we go about investing at TDEM.